economic environment, which is even more complex right now, right? But as a result, the main objective in developing this update was enhancing the reporting model for financial instruments. Next slide. So the effective date. So here, this could be, I guess, either good news or bad news for you. The good news is that it's already effective. So if you already implemented, then you don't need to worry too much about this. But the bad news is that if you didn't implement yet, you're late to the party. So the effective date for private entities for this update was for fiscal years beginning after December 15, 2018, or 2019 calendar year, and is another way to look at that. And then also just keeping in mind interim periods within fiscal years beginning after December 15, 2019. And then the effective date for public entities was the year before that, basically calendar year 2018. Next slide. All right, so now I'm just going to move through the main provisions. There may be a few other provisions in the standard that I don't highlight here in the slides, really just because they were not going to be applicable to anything that you all are seeing day to day on a captive insurance company set of books. But that's my little disclaimer that there might be a little bit of additional information in this update that we don't cover today. So the first main provision I want to make sure you're aware of is it requires equity investments except for those accounted for under the equity method of accounting or those that result in consolidation of the investee. So outside of those, equity investments must be measured at fair value with changes in fair value recognized in investment income in the income statement. Next, just making sure you note that an entity can choose to measure equity investments that don't have a readily determinable fair value at cost minus impairment, if any, and then plus or minus changes resulting from observable price changes in orderly transactions with an identical or similar investment of the same issuer. So there is also that option that you can measure equity investments at cost minus impairment. So just keep that in mind. That is an option. The next provision, item to note, important thing to note is only debt investments are classified as trading, available for sale, or held to maturity in the balance sheet now. So anything other than those debt securities, those classifications, those three classifications you're used to hearing about and seeing are no longer applicable. Next slide. All right, so a helpful thing that this new update offers is they've simplified the impairment assessment of equity investments without readily determinable fair values by requiring a qualitative assessment to identify impairment. Maybe before it was solely quantitative, but there's also qualitative information to be considered that this simplified things there. When a qualitative assessment indicates that impairment does exist, an entity is required to measure the investment at fair value. So whatever inputs you have, the observable inputs you have to help make that measure of fair value, that would be required. And next, this update eliminates the requirement to disclose the fair value of financial instruments measured at amortized cost for entities that are not public business entities. So before, if you had held to maturity bonds that were at amortized cost, you still had to disclose the fair value of those bonds, for example. And now for private entities, that disclosure requirement has been eliminated. So that's helpful. One less thing you have to worry about. All right, the next item is there's now a requirement for the entity to present separately in other comprehensive income the portion of the total change in the fair value of a liability resulting from a change in the instrument's specific credit risk when the entity has elected to measure the liability at fair value in accordance with the fair value option for financial instruments. So this is one that, again, I think this will be really rare on a captive insurance company's set of financial statements that you have a scenario where you have a liability that's on the books that you would want to elect the fair value option for. So again, I think this will be one that you probably won't see, but we wanted to make sure that you're aware of that provision of the update. Next item is this update requires separate presentation of financial assets and financial liabilities by measurement category and form of financial asset. That is, if it's a security or loan and receivable and this is on the balance sheet, or you can do it in the accompanying notes to the financial statements. And a little bit later on in my presentation, I have a sample set of financials and footnotes so that we can kind of walk through what that will look like. And then the next provision clarifies that an entity should evaluate the need for a valuation allowance on a deferred tax asset related to available for sale securities in combination with the entity's other deferred tax assets. So again, this is just a clarification here. This is something that we all are probably doing anyway. We know that when we are marking an asset to fair value on the books for GAAP purposes, that is going to generate a book tax difference that then needs to be accounted for through a deferred tax asset or liability there. So just remember that those available for sale securities do need to be the valuation allowance on a deferred tax asset there does need to be looked at and evaluated separately. All right, next up, it talks about what you do when you implement the standard. So any adjustment at the adoption as update will be made by means of a cumulative effect adjustment to the balance sheet as of the beginning of the fiscal year of adoption. So to clarify that a little further, the next item talks about these amounts that were reported in other accumulated other comprehensive income for equity securities that exist at the date of adoption that were previously classified as available for sale will be reclassified into retained earnings. So before, for those equity securities that were held that were classified as available for sale, your change in fair value was running through other comprehensive income and in your equity section in your balance sheet. But that with this new standard update, when you implement that change, you need to adjust that effectively out of your beginning balance of AOCI and reclassify that or move it into your retained earnings classification. And then going forward for that year, your adjustments to fair value, your change in fair value will run through current earnings in the income statement.